I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong.
Hi, I'm JB. It's finally time to start my series of the videos called Is It a Buy Now?
I'd buy that for $1.
I have for the longest of time wanted to start this series, but I always seem to get distracted by something else. I would like to simplify the process and create both a standardized procedure and a spreadsheet or an application to back it up. But there are so many metrics and so many things to consider when looking at companies and determining if I want to invest in them or not. And by now, a lot of other YouTubers have done something equivalent. Some I like, some I really don't like. The guys from Everything Money falls in the last category. The ones I consider genuine are someone like Joseph Carlson and his Qualtrim tool. He has a great channel, and Qualtrim is good for seeing trends and financials of companies. Sven Carlin also has a good YouTube channel. He does a very good job looking into the companies. He's a value investor, dividend investor. He doesn't have a fancy website or a fancy app, but he has a nice spreadsheet and he shares it for free. In this video, I will set the stage for this series and I'll go through the basics, show which metrics I use to identify a great business, and how I find the intrinsic value and what price I'm willing to pay for a share of it. Contrary to what most people seem to think, even shares of great companies sometimes come on sale. This means the intrinsic value is not static, so you need to follow your companies and financials and update your price targets on a regular basis. That's another reason why I always say you should not have 50 stocks in your portfolio. You should have around 10, max 15. You don't have the time to follow everyone at the same time. You only have time to follow a few ones at a regular basis. If you don't have your own stock tracker with a valuation method, then I highly recommend making one. Or even better, find someone who has already made a good one and use theirs. I spent a lot of time creating my own stock tracker, as I believe it's important to be able to track the progress and keep track of what you are doing and what you have been doing. And also, it's very important to have a goal. At some point, I will put it on Etsy.com so others can save a lot of time just by buying a copy of it and get started right away. Work smarter, not harder. So, what am I looking for when researching companies? Well, just like Warren Buffett, I usually stay within my circle of competence, or at least stay away from companies I don't understand, or companies I don't see having a real future, like airlines, cruise lines, a lot of auto manufacturers.
Hold up. Wait a minute.
Did I just say that? Oh, and wait a minute. Don't I have a large part of my portfolios in Tesla? Well, yes, but Tesla is not just a standard automaker. They're basically a tech company that just happens to use the auto part to make enough money to disrupt the energy business and the transportation business. And the final end game is the total labor and AI market. Eventually, Tesla will become one of the biggest companies on Earth. So, yes, that's not an automaker. Okay, back to the task at hand. For starters, I need to figure out which type of company it is and at what stage the company is in. All companies are just like humans. They start out small and grow and learn and figure out where they fit in and how they can grow bigger and get better. They grow and mature until they get old and stuffy and can't really get new ideas, or at least won't act on them anymore.
Morning, dickhead.
Hello, moron.
What are you,
Never mind. Just forget it.
who's the guy yakking at your door?
Just mind your own business, will you?
At the moment, I'm in the growth phase of my portfolios, so I'm looking for growth companies and don't really care about dividends or companies with single-digit growth rates. That's not to say that if I stumble over a great dividend payer, I won't run away screaming, but I will take some more time to investigate, and I will only invest if they still grow their business. Like Rio Tinto, for instance, a company I started researching a couple of years ago when I was researching Tesla. Rio Tinto is one of the very few mining companies that actually look ahead to the future, and they invest in technology to improve a medieval practice of digging stuff out of the ground. For instance, Rio Tinto has electric haulers that are also autonomous, and they're seriously bringing down the cost of mining. Well, what's my process and what do I look for? Let's just quickly list the first things I look at when trying to find companies I want to invest in. What is their product, and is it something that people will buy at scale? Do they make money on the product and or services? Or, if not, is there a clear path to profitability? What is the TAM, the total addressable market, and where are they on that? Are they disruptive? Can they overtake the current competition? Or do they have a moat, something that makes this company better at achieving and maintaining its earnings? And do they have pricing power? Can they determine the price of their products, or is it determined by someone else? Do they have great management with clear objectives and execution? How about employees? Are they loyal and willing to go that extra mile for the company? If you can answer these questions and you like the answers, then we can move to the next part and investigate if the company's financials and future prospects are good. Well, sometimes the hard part is finding the company. Here it's good to be a part of communities and a network that can recommend or help you find something. So sometimes I get a tip from somebody in the investment community, so I look into that. But when that doesn't happen, I kind of look at companies not often discussed in the media or by other investors. I tend to look for companies that most people don't look at. We all know we have kind of a country bias, so most Americans will only invest in American companies, most Danish people will only invest in Danish companies, and so on. That's just how it is. We feel more comfortable and think we have a better control or a better understanding of a company in the same country as we are in. And there's a little bit of truth to that too. But I want to find companies with high growth and high potential, no matter where they're based. So how do we find these high growth companies? This is actually the hard part, and as I said, without a network and to know a people, it's really hard to find something that you don't know you have to find. So you can use your imagination, or you can try to use the internet. Peter Lynch is of the understanding that everybody has an edge. Everybody knows something. It's just to figure out what is it that you know. Like me. In my day job, I'm a data analyst for a large IT company, and I interact with a lot of companies. And once in a while, I come across a company that says they're expanding like crazy. Why not look into that?
You saw way ahead of most people. That's an edge. You need an edge on something.
Another way is to maybe look at serial entrepreneurs. They usually do very well, and the bigger they get, the better they get at it. But beware that these are risky, and you will usually only get in when they go public in the initial IPO. And maybe it's better to wait a little while to see if the company actually has some traction. And as Peter Lynch always said, even after a 10x, a company can still be another 10 to 20x.
He said you have plenty of time. People are in an unbelievable rush to buy a stock. I'll give you an example of a well-known company. Walmart went public in October of 1970. You could have bought Walmart 10 years after they went public and made 35 times your money. You could wait 3 years after Microsoft went public and made 10 times your money.
So, let's say we found some companies we would like to research and need to go deep. What are we looking for? A lot of people look at different things. I always wondered, why not look at all the metrics? It's just like evaluating a person when you're on a date. It's like looking at a beautiful girl and ignoring all her flaws. You just know she will be a problem down the line, but you get infatuated by the looks. Don't do that. I'd rather find the great girl, which may not be drop-dead gorgeous, but she has the complete package and is guaranteed to make you a lot more happy over time. Hey, don't tell my wife I said that. I work as a data analyst in my day job, and usually when I'm doing analysis, I almost always end up knowing more about the company than most insiders do. Why not take the same approach with investing? Well, for one, it takes me a lot of time to look into every corner and part of a company. And if we want to analyze more than just a few companies every year, we need to find some shortcuts. As I said, I'm currently working on a valuation tool so I can automate the process a bit. But for now, I have to do all the hard work myself. But maybe that process actually helps me in the long run. I kind of do it like the famous investor Mohnish Pabrai, who learned his approach from Warren Buffett. Start from the top and work your way down. Maybe on the way you've developed some kind of a point system, and you know that if you get 20% in, that hey, this company is not for me, so you don't need to go deep in it. I want to know if the company makes money I want to know how much, as this relates to when I can expect to get my investment back and how much it will grow. The next part will be finding out what is that growth rate and will it be consistent? And then I have to look at the market, competition, execution, etc. So let's start with the financials. We go to the investor relations page and find the last 5 years of filings, or you can see if anyone has done the work and put it online. There are a lot of great sites online. However, the really good ones require subscription, and I'm cheap, so I'll sometimes find it myself instead. Macro Trends is a great site with a lot of good data, and it's free. At least part of it is free. Morningstar also has some great information for free, and basically you can find a lot of other great sites. The hard part is finding one with all the data combined. Here I use Macro Trends. There's also a site called Guru Focus. Very, very nice site, very comprehensive, but it has a subscription. Let's do an example. In this example, we do Intel. I start with applying the first gate. Does this company fit my template for an investment? Do people want or need Intel's products? Well, for a long time, that was the truth. Intel was inevitable and really had a great business. Now there's so much competition from AMD, Nvidia, and even ARM and others, so that's a small yes, especially on the device side, as Intel still doesn't focus on the mobile device market and don't have the real great products there. The only place they really make a lot of money is on the server side. Do they make money on their products and services? Or is there a clear path to profitability? Yes and no. They used to make a lot of money. They still do a little, but the last year has been hard. It has been declining, and with all the delays and problems, and now needing to onshore again, where they just offshored almost everything, the next 3 to 5 years are going to be very, very tough, and the competition doesn't have the same problem. What is the TAM, and where are they on that journey? Well, this could be an upside. There's so much attention on AI and the need for powerful backend system, and Intel still has the leverage here. However, the competition is right on their heels, and especially now that big buyers like Microsoft and Amazon, they're going into designing their own chips and working on systems for their backend. And with the success of ARM and Nvidia, I think Intel will have a problem growing and even maintaining their most profitable business. So in my opinion, the TAM is there, but it's just shrinking a little bit for Intel, or at least staying the same. Are they disruptive? Can they overtake the current competition? Well, definitely not. To call Intel a disruptor or innovator would be ridiculous. They're the poster child for old and stuffy. They're just making promises and don't deliver and keeps up appearance with advertising. Did somebody mention GM here? Intel is the company that gets disrupted, and the fact that a lot of their great talent have found other places to work is a sign of the future. Do they have a moat? What makes this company better at achieving and maintaining its earnings? Do they have pricing power? No, 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 and no. Intel should have a moat, as it has a lot of older sisters and programming that only fits its architecture. However, with a higher focus on cloud computing, that will not last very, very long. Business does not care what system performs the task, they just need a reliable system to do it and as cheap as possible. So in my mind, Intel's moat is drying up and becoming irrelevant. And regarding the pricing power, as we have seen in the last couple of years, they definitely don't have that. They are getting disrupted. Do they have great management with clear objectives and execution? Again, not really. But with the return of Patrick Gelsinger, that might help a little. Before that, Intel had been a flip-flopper and didn't really represent a clear strategy and project confidence in their future. But I really don't like this Kivan Isfarani guy, who has been in charge of manufacturing, plant and quality control. What a crappy job he's been doing. And I don't like that he came from the old stuffy automobile industry either. So no, there needs to come fresh new blood into the company and disrupt the old slow management. If this doesn't happen, they're going to be the next Kodak or Nokia, a company that once was great, but is no more. How about employees? Are they loyal and willing to go that extra mile for the company? Well, there's always great employees at any company. And with the 2080 rule, it has worked for some time. However, I believe Intel is down to a 595 rule. And when those 5% that are exceptional start realizing this is not the place to be, that's enough to pull the rest down. So no, they have lost their appeal among the new smart engineers, and if they don't get it together soon, they're on a dire path. Granted, it will take some years, maybe 5 to 8 years, but by then, Intel will be a shadow of its former self. But let's ignore everything I just said and dive into the financials anyway. Even if the above mentioned would be enough for me not to look any further. So just for the example, let's continue the process anyway. I want to know if the company is making money, or at least the clear path to profitability. So I look at revenue and I look at income, and here I want to see a nice growth rate, and if not, a very good explanation for why not. And if not, a path to getting there. There has to be some real indicators that they will make money in the future. I look at how fast I can get my invested capital back with at least 10% gains a year. If the company does not return that much, I won't invest. When we look at Intel's revenue and income, we can see that Intel has had some very rough years. It all looked good until 2012. At that point, people scaled back on the PC buys and getting iPads and mobile devices instead. That has really hurt Intel. And that was even without the big AMD competition, as AMD was still having a little trouble themselves. From 2012 to 2016, Intel didn't grow as expected and had to rely on the Xeon CPUs to create income. And the biggest problem here is they didn't understand, or maybe didn't believe, in mobile phones and the tablet market. Maybe a little of this was Microsoft's fault, as Microsoft tried to help out with the Surface tablet. Without a great OS designed for touch, this didn't work out well for any of them. And with the PC processors being on the pricey side, Intel could not reach the desired growth rate. So in 2016, Intel finally made the Kaby Lake and dumped the backward compatibility and focused on the future. And with the boom in tech and tech servers needed, Intel was back on track and seeing a nice growth. Until 2018. A lot of problems suddenly appeared as Google released the paper indicating serious problems with almost 90% of the processors from Intel. They had a lot of vulnerabilities and exploits, and this cost Intel very much in time and effort. It took them almost all of 2018 to do releases of bug fixes, updates, and other stuff just to get back on track. And again, having to delay the much-awaited 10nm chips, investors and the public kinda lost faith in Intel. And what do you know? Along came COVID and jump-started the need for chips once again. No matter what chips were in stock, they could be sold at a premium. Great news for Intel. But again, the future beyond COVID wasn't rosy. More delays, more lineup problems, Apple dumping Intel to use its own silicon, AMD being a fierce competitor. All of this made Intel decide to outsource its production to TSMC. What a bad idea. From the end 2020, Intel hasn't really done much. And if you ask me, the outlook for the future does not seem great. Even though if the government is out with onshoring new production facilities and helping out, I don't see the clear path to growth, and with Intel consistently missing deadlines and pushing out new chips, and the stronger AMD and ARM competition is getting, I'm not betting on that story. And as you can see in the financials, they are a true mirror of these problems. They match the exact dates. But let's take a closer look at that. As I said earlier, let's start from the top and work our way down. Revenue took a serious hit, going down 20% from 2021 to now. That's $16 billion that didn't realize. That's really a bad sign when a company takes such a hit on the revenue. Net income went from $19 billion in 2021 to $8 billion in 2022. That's a 60% drop. Earnings per share goes from 486 to 194, also 60% drop. Imagine being a stock owner and your expected return just get cut in half. Intel's two largest sources of revenue, PC and server CPUs, both went down 23% and 15%, which in my opinion is a disaster. The worst part of all of this is their 2023 guidance. Intel expects a further 28% drop in revenue and a negative earnings per share. What? When a company suddenly decides their machinery and equipment can be expanded lifetime from 5 to 8 years, thus reducing depreciation, this is what I call cooking the books. The only reason you do that is to look more attractive to your shareholders. And what they should have done was increased research and development. Instead, they reduced research and development by almost $500 million. I would say Intel is in serious problems. As Intel had just outsourced everything almost, and now they're scrambling to onshore again, this is gonna give what, 2, 3, 5 years, bad years? If they only would focus on the mobile market, as the rate of replacement here is a lot higher than the PC notebook market, and focus on the need for stronger server CPUs to power AI revolution. But no. Instead, the competition from Nvidia, AMD, and now ARM also is so strong I don't see a clear path to my desired growth rate at least. So I would rather find something else to invest in. And to those who say, hey, Intel is cheap at these levels. What? I'll say, look at the Altman Z-score. The Altman Z-score is around 208, which is in the gray zone and usually what we call the distress zone. If it goes below 1.8, the risk of bankruptcy within 2 years is a real scenario. Remember, Intel has a debt-to-equity ratio of 0.76, and I would not count at least 35 billion of assets that Intel puts on the books, like the 28 billion of goodwill. Huh? Really? Intel is in problems. I believe they are only at the current valuation because they are part of many of the ETFs and a lot of dividend investors' portfolios. Maybe a lot of people believe the story will be better. I don't think so. They're in trouble, and even though they're in trouble, they still paid out 6 billion in dividends. Why? Why would you do that? If not only to appease investors. That's the only reason. I think a lot of investors think Intel will bounce back, but my opinion is they're doomed. It's just going to take 3 to 5 years before it becomes very obvious. Looking at the current price levels, Intel is way overvalued. The PE should be around 8 or 9. Just look at the PE over time. So Intel is definitely not for me. In Intel's case, I feel like I did not need to go very deep in the financials, but I could be wrong, and Intel could be a so-called turnaround. And yes, this is a possibility, but as Peter Lynch said so many times, you don't need to perfectly time a company, and even after it comes around, you can still get in and make a bundle. And looking at these financials and the current valuation, I would not consider Intel a buy. So just for the fun of it, let's do a quick EPS calculations, earning per share, and see what we could expect in the future if it turned around. EPS for 2022 was $1.94 per share. EPS for 2023 is guided to be negative. Not good. 2024, probably, now we're in the guess area, probably we will probably be positive, at least 0, maybe negative, maybe 0, just around that level. 2025 could be okay, maybe at the 2022 level. So let's say Intel comes back and gets around $2 EPS in 2026. So for a 5-year period, I'll go with a 10% annual growth just to be conservative. The forever growth rate I'll set at 2% just to be safe. And as I believe I can get 12% on other investments, I'll use that as my benchmark. If you don't believe me in that, then take a look at my other video of how to make the perfect portfolio using only ETFs. Okay, with those numbers, the intrinsic value for Intel is around $27.28 per share. And as I want a margin of safety, my buy price is below $22. So we were almost there in February. And you could argue that the dividends could offset that small difference. However, Intel just slashed the dividend to 12.5 cents per share, a cut of almost 2/3 from what it paid back in 2022. So nope, Intel's not for me. Even Coca-Cola has outperformed Intel double the last 10 years, and they also pay almost 3% in dividends. Even the S&P 500 has outperformed Intel by a factor of 2 times in the last 10 years. So I'm sorry, investment-wise, Intel is not for me, at least not for this time. This time we didn't get to go through my entire process with Intel, but let's see how the next company I'll look into fares, and hopefully it's interesting enough to get a lot further. I hope you got some value from this video, and if you did, please hit the like button so others may find the video. And on that note, I'll say adieu and hope to see you in the next video. Remember, the best investment you can make is in you. The more you learn, the more you earn. Bye!
I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong. Let's break it down for a minute. I want the crown, I'm gon' get it. You hear me loud, man, I'm winning. Yeah, Charlie Sheen will be grinning. These ladies know that I'm sinning, and this is just the beginning. I'm closing in the ninth inning. There ain't no point in resisting. Living